This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome, everybody, to the Planet MicroCap podcast. I'm your host, Robert Kraft. Thank you all so much for the support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. You're listening to episode 150. If you have any questions or comments, please feel free to tweet at me or shoot me an email at rkraft@snnwire.com. And when you do get a chance, if you like what you hear, please rate and review Planet MicroCap on iTunes. It really helps provide feedback for me and spread the MicroCap message. Quick reminder, the SNN Network Canada virtual event is coming up on January 6 and 7, 2021, with lead sponsor Small Cap Discoveries, one of the leading Canadian small, micro, and nano cap newsletters. We have teamed up to highlight our neighbors to the north, Canada. We have our initial speakers up there right now on our website, which is canada.snn.network. And we actually just added a few more speakers over the last day or so. So be sure to go and check them out. Many more speakers that we'll be announcing, as well as our presenting company lineup, which is I'm really excited to share that with you all. So I'm really pumped on this event that we have that we're putting together for a while now. And be sure to register for the event at canada.snn.network to join us for an incredible microcap event to kick off 2021. Again, that's canada.snn.network and click the register button. I'll see you there. This week on the SNN Podcast Network, on In the Market Trenches with Gary Reeby and Eric Fury, our hosts welcome guest Mark Vonderwell, better known as Googie, on the MicroCap Club. He joined Gary and Eric via telephone to chat about what else? War stories. So you can check out this episode on Apple, Spotify, YouTube, or Podbean at inthemarkettrenches.podbean.com. Now, for this episode of the Planet MicroCap podcast, I spoke with Eric Boroian. Eric is a full-time investor based in Paris whose handle is at EBOROIAN on Twitter. I was introduced to Eric by one of the best microcap investors in the game right now, Meredith Brill, at LockstockBarrel on Twitter. That's LOCKSTOCKBARRL. It was funny because I honestly was expecting to be speaking with someone from France with the French accent. So it was a little surprising to get on the Zoom and hear Eric's Chicago accent. But all jokes aside, I thoroughly enjoyed my conversation with Eric as we dive deep into his investing process. And if there's any takeaway from our chat that you will hear with investing, be creative, think outside the box, and use that damn imagination of yours. Let's go. Thank you again for tuning in to episode 150 of the Planet MicroCap podcast, and please enjoy my conversation with Eric Boroian. Welcome back, everybody, to the Planet MicroCap podcast. I'm your host, Robert Kraft, and joining me right now, my guest for today is Eric Boroian. Eric, I'm so stoked to have you on today, man. How you doing?
Thanks for having me.
It's great to have you on. So Eric, just to, look, I wanted to say his last name really quickly because I had just gotten it, but Eric is a full-time investor. He's based in Paris. He's got a really awesome background that we're going to get into today. And we're going to give, from the jump, we're going to give a shout out to Meredith. Thank you so much for connecting us. I think anybody who follows Meredith Brill on Twitter at MBB, she's one of the best, most talented investors out there. So Eric, you came highly recommended. You better not disappoint right now.
Well, I hope not. Thanks a lot, Meredith. I really appreciate, the recommendation.
Very good stuff. Very good stuff. All right, man. Well, Eric, look, how we always start each interview is I really would love to get your background. Where did your passion for investing begin?
Sure. So I guess my parents are both American. I was born in Chicago, and we moved to France when I was 6. So I guess a big part of the investing sort of journey starts with my parents, because my mother's an accountant. So she's sort of very rational, very detail oriented, very meticulous. My father works in the luxury goods industry, and it is sort of much more on the creative and imaginative side. And so, when we were younger, they talked about business all the time. They both invest in the stock market. They both have sort of investment portfolios. My mother is sort of on the consumer staples, sort of very durable businesses that, she's held for a long time. And my father is more, highly concentrated, sort of 2-3 positions in his portfolio, and in sort of industries that he knows really well, also very long term. And so, sort of watching that, I guess, influenced me. And then when I was sort of 16, 17, a couple of friends started investing in the stock market. And so we started, talking stocks and businesses. And that's sort of, how I got into it initially. And then from there, I think I did what a lot of people did. Is I read a lot of books, made a lot of mistakes, and then, progressively decided that I might want to do this, as a job. And I think I got sort of 2 pieces of advice from my parents, which I think were good pieces of advice. And the first was that, investing is about more than just numbers. And so, it might be a good idea to have an education that sort of is more wide ranging and looks at different aspects of business and not just finance. And so, I studied business management at undergrad, and then, actually economic sociology at grad school. And that was more sort of, I was very interested in sort of crowd behavior, in psychology, and it allowed me to sort of blend those 2 things together. And then the second piece of advice was, if you're going to analyze companies for a living, you might want to work for one first. So I spent sort of 2-3 years working at Vivendi on the music side, which is an exciting time, because it was sort of I guess about almost 15 years ago now, and it was right as the industry was starting to shift towards streaming. It was the very early days of Spotify. And so I spent some time there, then got an MBA and joined the sell side, spent almost 3 years there, and then transitioned to the buy side. So I guess that's sort of the short background.
Very good. Very good. I mean, look, we can go down many different rabbit holes right now, but first things first, what was that initial experience for you that you're like, all right, I'm hooked, I'm in, let's go?
Well, it was a good experience in the sense that I initially had some success. And I think if maybe I hadn't had the initial success, I might not have been as passionate about it. In the end, so, this is like 2001, 2002, 2003. I was, I got very interested in sort of the traditional value approach. I bought a lot of stocks that had, that looked cheap, that had, emerging market exposure, industrial exposure. They all did very well. I thought that, it was because of the analysis that I'd done. And in the end, when 2007, 2008 came around, I sort of learned the hard way that I was actually just playing the same theme in different ways. And none of the performance was stock picking. And most of it was just, that was a period when, sort of inflation was rising, interest rates were rising, value was outperforming, emerging markets were outperforming. And it just so happens that those are the types of stocks that I held, and I didn't have very much balance, and, made a lot of mistakes. And I felt it pretty hard in 2008, 2009. So, I think it helped me, get the initial passion, but also learn not to be too confident and not to be too one-sided in my approach, or too, I guess, ideological or dogmatic in the way that I approach investing. So those are sort of the first few years.
Very cool. So then I also have to ask about, those dinner table conversations with your parents talking about investing. I mean, that must have been some of the most fun stuff. And remember, I mean, you laid out 2 things that you remember specifically, that piece of advice that your parents gave you. So clearly during those talks, I mean, that just had a huge impact on you. I mean, that's not rocket science to even, or revolutionary to really say right now, but I mean, what were those dinner table conversations like? What companies were they looking at? I mean, this is a microcap show, so I can't help but ask. I mean, were any microcaps talked about?
There were no microcaps. It was more sort of like the Costco's and the Unilevers on one side, and then the sort of LVMH and Hermes on the other side. And it was really just talking about the different businesses and what makes them tick and what makes them different, and discussing the management teams. And there was just very, varied conversations. But, I guess at the time I didn't realize it, but what they have in common is that I think it's about sort of their temperament and the very long-term view and the ability to stay calm under pressure and volatility. Those sort of things, that maybe they discussed, but I didn't really internalize until I went through it myself, I guess. But, I guess kind of lucky to have that kind of situation, initially.
Very cool. All right. So let's dive right in, because we got a lot to cover with your investing process and some of your tweet threads that you put out there that I found just fascinating. And, one of the questions eventually we're going to be talking about your passion for guitar and jazz guitar, because that might be an hour on its own, because I grew up as a jazz drummer. So that'll be pretty fun. Cool. But okay. But we'll get there. That's our cliffhanger for everybody to listen to all the good stuff before that. But let's dive right in. What would you say is your investing process, and what would you say makes that process different from some of your peers out there? There's a lot there. That's a loaded question. Here we go.
I guess there are sort of three things. If I had to, simplify it, is that I look at a limited number of industries and business models. I research higher quality companies, and then I try to get involved when there's a mispricing. And I don't think that that's particularly different from many other investors. It might sound like what I'm saying is buy good businesses when they're cheap. I tend to think that nuance gets lost in simplicity. And so it's the nuances that make the difference, because you see a lot of people have very similar approaches, but their results are very different. And I think it's because there's these nuances and people don't necessarily discuss them often enough. So I guess maybe if I discuss a little bit the nuances of each of those different elements, maybe sort of starting by the industry sort of aspect to things. And
well, here, I'll set you up for that, because I may have sent you the question so you know what I'm about to ask next, and that's getting into the nuances of some of these things. So here, let's go through each point individually. So let's start with that first one. We're talking about limited industries. I believe, quite frankly, that one thing that's really taken for granted is in the discovery process, and it can be overwhelming. And I found myself when I was getting my start and thinking about investing and doing investing, and this is where I just always got lost, was like, okay, I want to invest in this particular sector. Now what? Or industry. And then from there you go down the rabbit hole in that sector, but then you potentially miss something about a sector that's tangential, or, it's the picks and shovels of this one sector that's so hot, but here's something that's going to be servicing that's, even just hearing this question, I'm trying to spit it out now and it might never end. I'm going down the rabbit hole of asking this damn question, so I'd love to learn more about this. How would you say looking at limited industries is different for you? And talk to us a little bit more about this industry maps that you guys use as well.
Sure. So I guess from an industry standpoint, I think that I tend to stick to industries where I have some sort of experience, either sort of financial experience because I was covering on the sell side, or operational experience because either I worked in them or someone I'm close to works in them. And so the combination of that, leads me to have some sort of expertise, even though, I don't want to claim that I know all these industries like the back of my hand. But, they tend to be oligopolistic and they tend to have structural growth. So, food, beverage, and tobacco, home and personal care, sort of luxury goods, media, software and technology, services, whether that's B2B services or healthcare services, industrials, sort of, I stick to those sort of sectors, and they tend to have high returns on invested capital as well, because, the subcomponents are quite, consolidated. And then the industry map idea really isn't my idea. Michael Mauboussin, has, I guess, initially put the idea in my head, years ago. And, he has that one that I think a lot of people have seen with sort of the airline industry. And really the idea was to just build that for all of the industries that I follow. And I think the advantage of that is that you really break down the entire value chain. And that allows you to identify subcomponents that are particularly profitable and why, and to identify areas of future growth and maybe changes in growth and, accelerations or decelerations. It allows you to identify sort of niches and niche players. So if I give you an example, in the food and bev industry, there's a company called Corbion, which I'm a shareholder of. And that company is a leader in lactic acid. And lactic acid is used, historically for preservation of food, meat and bread. And it can also be used, and this is more recent, in the production of a biodegradable plastic. And it helps produce what's called PLA. And Corbion, I would never have heard of Corbion if I weren't speaking to companies like Unilever and Danone. And I didn't have a sort of map of the industry, and I wasn't trying to understand the entire value chain and figure out, and ask questions really to the companies and say, is there anyone within, your space that's doing something innovative or it's doing something different and that's particularly unique, and that they mention this company. And then when you look into it, you start understanding that, there's a new trend, and that companies want less CO2 emissions. They want, something that's more sustainable in terms of their packaging. And then this biodegradable plastic potentially provides it, and that they're uniquely positioned because there are only 3 players that provide lactic acid really on a grand scale, and they have 40% market share globally, and they're in locations where they have sort of lower costs in terms of feedstock, because usually it's carbohydrates that allow you to produce lactic acid, and that they formed a joint venture with Total, who's an expert in the field, and that they've started producing it already. If you don't do the industry maps, I think it's hard to find those sort of ideas before other investors hear about them. So I've been a shareholder of Corbion for 2 years, and, now you're just starting to get brokers that are covering it because they've announced, capacity expansion, and which is going to lead to, I think, quite a bit of improvement in growth and eventually margins. But that move has already started, and it started a while ago. And I think that if you want to anticipate things, having industry maps and speaking to people along the value chain is super useful. And so a big part of that is also just creating a network of contacts in different subcomponents and speaking to them on a semi-regular basis and just asking them questions about what's going on. And, I think that a lot of people say that they do that. And I think that, that what I'm describing is a little bit different from sort of doing expert network calls. It's not the same. And I think when you've been following industries for a number of years, you sort of start to gain a network and really be able to use it in a different way. And so I guess that's from the industry standpoint, I guess that's the one of the differentiators.
What would you say when in your experience now, you've been doing this for a while now, in kind of putting in those 10,000 hours to even understand more those industries that you're interested in, for those listening that want to really get after it and really understand an industry that they might have some interest in, and maybe some of those subsectors within that industry, what are some suggestions that you'd have for them so that maybe they can find some of these businesses before, some other investors, let alone some institutions?
Sure. I think there are 2 or 3 things. The first is this might sound obvious, but trade magazines are super useful, and trade websites. I'm subscribed to a lot of them. I think that's a super useful way of figuring out things maybe before it becomes obvious to others. The second is to use LinkedIn a lot. The hit rate's not that good, but, if you word things well and if you send enough messages, you can usually get in touch with people in some form or another that work in an industry or a part of an industry that you're interested in. And then, the third thing I think is Twitter. Twitter is super useful for that. You'll find a lot of people that work in different industries that are present on Twitter. And if you search the right way, you can usually come up with a small list of people and get in touch. And I've had a lot of DMs with people in different subsegments of industries, via Twitter as well. So I think if you combine those 3 things, you have a reasonably good shot at getting some insight.
Very good. All right. That's how we got connected, I probably, listen, I can't help you too much on industry front, but I'll interview you, so that's good. All right. So let's get into your second differentiator. And you talk about, you're looking at quality companies differently. So what do you mean by that? And this is really more or less your criteria for potential investment. So love to learn more there.
Sure. So I guess the first thing I'd say is that I think it's important to differentiate between the sort of inputs and the outputs. And often as investors, we tend to sort of mix those together. So you'll see people say, I'm looking for a business that is predictable, free cash flow generative, is dominant, has, large barriers to entry, earns high returns on capital, and has a good management team. And all those things are fine. I guess
buzzword. Hey, I use those buzzwords to sound very smart. Okay, so let's not, let's not sully them too. No, I'm just kidding.
I guess that all of those are fine. I think that what's important to do though is to separate the inputs from the outputs, because some of those are inputs and some of those are outputs. And so the way that I like to sort of think about it is that if we start at the ultimate output of what quality is for me, it's basically a business that, can generate significantly more free cash flow per share 5, 10, 15 years from now. That's the bottom line of what the output is of all the other things I'm about to discuss. And so if we take it maybe from the start and we go back to the beginning, I think that, the first sort of 3 things that I'm looking for are sort of an attractive customer value proposition, a good industry structure, and a competitive advantage. And I think that, and most importantly, the second derivative of all 3 of those. So I want, an attractive customer value proposition, but that's improving, a competitive advantage that's strengthening, an industry structure that's getting better. And when those 3 things are present, typically you have high returns on invested capital, or at least the potential for high returns on invested capital, depending on the maturity of the business. And so, those 3 things are inputs for the output of high returns on invested capital. And then to that, you have to add a good management team. And there, what I'm looking for is sort of aligned incentives, super important. So typically I like, family shareholders, or owner operators or founders. I prefer for them to sort of be quite innovative in their culture, to be adaptable, to have excellent sort of operating and capital allocation records. And the combination of a business with high returns and a good management team is that, there's essentially 3 things, and it's going to drive how much capital is invested, what kind of returns are generated, and, the competitive advantage period, which is sort of how long are those going to be done. And the combination of those 3 things is what leads to, significant value creation in the future, and therefore, as well, much higher free cash flows. And so, that's sort of how I like to think about things. And on those 3 things, the invest more capital, the improve returns on capital, or, the extend the cap. In practical terms, what in the invest more capital, what I'm looking for is sort of growth opportunities. And that might mean sort of a regional expansion or capacity expansion or new products or services. In terms of improving returns on invested capital, I'm looking for, sort of pricing, mix improvements or business model shifts, cost improvement, better efficiency. And then in the extending the cap, I'm really looking for them to sort of enhance switching costs, I guess is one of them. And there are a host of other things, depending on the type of competitive advantage that the business has, that those can be extended. But that's sort of how I have a little sort of map, which I sent you, which is how I think about those things. And then, they're circular in a way, right? Because, the management team is also going to have an impact on the competitive advantage, and whether it's strengthening or weakening, it's going to have an impact on the industry structure. It's obviously going to have an impact, on where capital is invested and why. And sort of, I like to see that osmosis of those different things together. And then there are other patterns that also represent quality. There's a great book called Quality Investing, which describes those patterns, which I think, are important. But that's sort of how I think about it. And I think that thinking of things that way allows you to anticipate as well. Because it's easy to look at ROIC in the past and screen over the past 10 years and say, this company has a high return on invested capital. It's a little bit harder but I think more required today, given how competitive markets are, to anticipate improvement or even, high returns on capital. And there are a lot of businesses that aren't profitable today or that are marginally profitable that have the potential to generate very high returns. And those might not be found by other investors if they're screening for simple metrics and just looking at the past. So, yeah.
All right. Well, so my quick follow up to that, I'd say is, for you, because a lot of what you're saying is, there's a good amount of investors that look at some of the similar stuff that you're saying. But for you, where do you where are your differential insights? Where do you find them? Because where is it on the margin, really? Because as I said, a good amount of investors I've interviewed over the years, they've mentioned, some or all of what you said that you also look at. But for you, where have you found your best ideas because you were able to have a differential insight on that one particular thing?
Sure. I guess we'll get to this when we discuss.
Sorry, I'm asking a lot of loaded questions. I swear I'm really not trying to throw you any curveballs. I promise. I'm just I'm a four-seam fastball pitcher mostly. But anyways, all right.
Yeah. I think that the difference for me probably comes in because I separate things in terms of the inputs and the outputs in that way. I think I tend to find situations that anticipate, high returns on invested capital or improvement in invested capital. So, for example, I've been a shareholder of Spotify for the past sort of 2.5, 3 years. That business is loss making. So, if you're looking to screen for a business with high returns on invested capital today, you wouldn't consider Spotify to be a quality business. And I think that the debate that you hear in the market is that, they are sort of dependent on labels. They'll never get an improvement in gross margin. They don't really have operating leverage. I mean, these are the common things that you hear when you think about Spotify. And by the way, I'm a shareholder of Spotify. I'm also a shareholder of Vivendi. So I may be one of the rare people that is shareholder of both. So I'm I don't have this bias where I'm sort of like the labels are the winners or Spotify is the winner. But if I think about the competitive advantage of Spotify, and if I think about the industry structure and how those things are going to change, the first thing, if you think about the different types of competitive advantage, and I'm sure you've heard these from other people as well, intangible assets, economies of scale, switching costs, network effects. I think that Spotify combines various elements of those. In terms of switching costs, I think the most common thing you'll hear is, everybody has access to the music and has the catalog. So that's not really a competitive advantage. That's right. But I think that switching costs are higher than people assume, because when you get accustomed to a user interface, when you build your, playlists, when the algorithm starts to understand what kind of music you like and recommends music to you and podcasts to you, to start all that over is time consuming and really a nuisance. So I think that people underestimate the switching costs. And how could we check if that's true? We could look at the most mature markets where they have high penetration, like in the Nordics, and that they've implemented price increases and that the churn hasn't gone up that much. In fact, has hardly gone up, and that they're going to be testing those price increases in 7 to 8 more markets probably over the next 12 to 18 months. And we'll see if churn increases there. But if we see that churn doesn't increase that much, despite, the competition, with Amazon and Apple, et cetera, then the conclusion will probably prove out that that actually there are more switching costs than people initially might have thought. And then so that's I think a component is that when you think about it and split things this way and trying to anticipate things, I think that's one element of it. And then there are other elements to Spotify as well. It's sort of like the gross margin argument. There's two sides to that. The first is that there are ways that they can improve gross margin that don't involve renegotiating with labels. One of which is shifting the mix of music played away from labels and more towards sort of independence, where they're paying, where the economics are different, and therefore today I think it's roughly 87% of music that streams is from the major labels. It was 5 to 7 percentage points higher a few years ago. That is going to continue to trend down, and the split with labels and publishers, if you combine them, is like 70-30. It's a lot less for the independents. And if that keeps, sort of shifting down towards sort of 80, 75, 70% over the next few years, that's going to impact gross margins in a good way. The second thing is selling incremental services to labels and data analytics, and I think that's also going to help. And then there's some pricing, as I said. So and the labels want those price increases, obviously. So in terms of price increases to the end consumer. So if you get those things, I think gross margins can actually improve a reasonable amount, and they've guided to a certain level, a certain range. I think that if you look at the labels a few years ago, they guided similarly to sort of very limited margin improvement and et cetera, because they don't want artists to see that they're getting much higher margins, and so that might lead to some renegotiations. And so I think Spotify's doing the same thing on their gross margins. And then beyond that, there's if you look at how much they spend in terms of OpEx, there's various areas, including R&D and marketing expense, that I think can come down as a percentage of revenue over the next few years. I don't see the reason why those things would have to scale up, and so they should get some operating leverage. And so I guess the point is, you could end up seeing a business with sort of 5 to 10% operating margins, if not higher, in sort of 5, 6, 7 years. And given the amount of growth, you get a pretty decent amount of free cash flow coming out of the business. And so I guess what I'm trying to illustrate with that is that, the way I look at quality is not just, using static inputs and trying to extrapolate. It's more thinking about, the real drivers of things and how those are evolving over the sort of the medium to long term. So that's sort of one area where I think it's somewhat different than I think what other people might do. And then the other thing is a big focus on management, and really, and this is the best way I can describe it, is there's a great Mark Zuckerberg quote from when he was asked sort of, why didn't you sell to Yahoo in 2006 for $1 billion? And his answer was sort of, there were various things that didn't exist yet, and therefore that they didn't include in their valuation, and therefore they undervalued the company. And I think that the important thing with management is it's not just to find management that's done share buybacks at an opportune time, that has a reasonably good allocation track record in terms of a host of things. It's also finding management teams that are innovative and creative, and that are gonna I think create products and services that don't exist yet, and do so continuously. And that comes back to if you've read Phil Fisher's book, that second question is basically that. I mean, you're looking for management teams that are going to find, a way to replenish continuously their pipeline of innovation and new products. And because the products don't exist yet, they're not included in people's models, and therefore they perpetually surprise to the upside, and the intrinsic value increases and the share price outperforms. And so I think spending a lot of time on management teams and culture and how they're going to be able to create maybe new products and innovations, and being imaginative on those things, and I think that Facebook's continues to be a good example of that today. I think, I'm also a shareholder of Facebook, and whether it's sort of, monetization at Messenger and WhatsApp, or, the shopping aspect at Instagram, or, virtual reality with Oculus. I mean, there's a host of areas where, they're able to create new revenue streams, potentially in various ways that are continually not well appreciated. So I think thinking about management in that way is in how that impacts where capital is invested, the returns that are generated, and et cetera, is another thing that I spend a lot of time thinking about on quality that's maybe a little bit different.
So, I asked a similar question to what I'm about to ask you on my other show that I do called the Investors Roundtable. And I was talking about innovators and these, revolutionary business minds. You're thinking of the Steve Jobs, Mark Zuckerbergs, the, Reed Hastings, you name it, right? How for you, are you able to say that person's an innovator, that person's imaginative? And maybe taking it a step further is, how do you think you would go about recognizing one of these individuals prior to the crowds now all agreeing yes, this person's a genius, that person's a genius, their business, they might be at a losing money right now, but they're a genius. Don't worry. It's going to pan out for them, so how do you think about that?
That's a good question. I think really just immersing yourself in the person and the team, and reading, everything that you can about them, and listening to interviews, and reading transcripts, and seeing the way that they think. I think the only way to do that is, and I'll give you an example. When I look over a business, I'll often take, 4, 5, 6 years of quarterly transcripts. I'll print them all out and I'll read. And for me, that's a good way of seeing sort of, how they think. And then obviously you connect that with reading the annual reports, and you connect that with, spending some time, watching any interviews they've done, and, progressively. And I, you could have done this with Steve Jobs a long time ago. I mean, well prior to, I think, when it became obvious to other people. It's sort of tough to describe. I mean, it's sort of like asking, how do you know when you've identified a good jazz musician? Do you know what I mean? It's sort of, if you listen to a lot of music of that player, and you listen to them in a lot of different situations, you sort of start hearing a way of interpreting chord changes, and interpreting songs, and playing the right notes at the right time, and atypical notes at certain times. And
Right.
And sort of, if you listen to a lot of jazz, you sort of start figuring that out. And I think it's the same about management.
Well, you know what I think maybe the question is, it's really the difference between like a really, really, really good salesperson and really an imaginative thinker and a creative thinker. I mean, if somebody is both of those, I mean, I guess that's the crown jewel, of course. But I mean, I'd say that's something that, especially for the lay investor, is probably sometimes very difficult to really discern. Is like, all right, is this person just really able to tell this? They're just, you put them on an interview, they got their talking points, they're killing it, and they're even maybe able to sound imaginative and creative, or maybe, but you don't realize that behind the scenes, that's their team of people that are helping them get to that point, versus, the Steve Jobs and others out there who, they're a singular force that you're like, all right, that's it. I think that's something that, a lot of people get caught. Sometimes I do interviews on a daily basis with some of these CEOs. I get caught up all the time where I'm asking myself afterwards, I'm like, are they good salesmen, or are they actually, a true innovator in the space? Like, it's sometimes very difficult. And then on top of which, then you have to ask the question of, all right, if they're an innovator and creative, do they know how to run a business? then you have to go there, and then you go on that roller coaster. I'm sure you've dealt with that plenty of times.
Sure. No, it's true. It's not an easy question to answer. But I think
it's like the art of it.
I'll give you an example. Yeah, I'll give you an example with Zuckerberg. There's some leaked emails that you can find online of him discussing various topics. And if you read through those emails, you think you get a pretty good sense of how forward-looking he is, of how atypical his reasoning is. It's at least to me, that was a pretty interesting thing. I mean, when reading through those, I got a good sense of what he's like, and it's kind of like, when you see it type thing.
Fair enough. All right. So we're getting to the third and final differentiator here. So I'm actually, you put out a Twitter thread that was very similar, talking about why things become mispriced. That's one of your core things for differentiation is mispricing. So, why do things, in your opinion, why do things become mispriced, and how do you assess mispricing and valuation differently?
Sure. So I guess on mispricing, I think that, I'm sure you've heard this a lot, stock prices fluctuate more than underlying business value. I think that's a given. But I think that the market is, for the most part, quite efficient. So there are like marginal mispricings and small mispricings relatively often, but large mispricings don't occur that often. And I think that, when you think about what mispricing means, what it really means is that expectations are unduly sort of pessimistic or optimistic. And so I like to think through sort of the ways in which consensus expectations can be wrong. And they can be wrong in only a few ways: sort of direction, magnitude, duration, timing, risk of free cash flows. That's sort of how I think about it. And I need to have a different view on at least one of those and be right for it to work out. And so when I sort of wonder, why do those things happen? why are the mistakes made on those 4 or 5 different things? It usually, if you take it back to first principles, it usually comes down to 2 things. It's either that investors are exaggerating something, in which case it's, behavioral, or it's that they're missing something, in which case it's, analytical or technical, or maybe even to a lesser extent now informational. So if I think about the sort of investors exaggerate something side, the typical ones that you'll see are sort of temporary company issues that are extrapolated by investors, and it might be sort of a restructuring or a division that's going through a tough time, etc. Second thing might be sort of a segment or a region that's in a cyclical slowdown. I don't invest in this sector, but I mean, oil a few years ago is an example, or even earlier this year could be an example. It might be sort of a recession or a general slowdown. It might be things like sort of politics or the hostile Fed, or there's a host of things, but those tend to lead to exaggeration in some way or another. And then on the investors are missing something side, I think that there are different types as well. There's 3 or 4 things. There's the ones that are well known, sort of it's underfollowed. So MicroCap or small cap, companies that don't give guidance and things like that. There's sort of situations where quantitative screens don't reflect reality, either because, for example, the company reinvests via their P&L, or there's a host of reasons why a quant screen might not pick something up, so people miss it. There's time horizon, so where people are focused on the next few quarters, where as the real story is sort of 3, 4, 5 years from now. And then there's corporate change, and that is sort of the area that I focus on the most. And I think that that comes from a few different things. I think it really initially came from just examining great investors and trying to figure out what they had in common. And whether it's sort of Karen Nelson in Australia, or Paul Marshall in the UK, or Bailey Gifford in Scotland, or Henry Ellenbogen, or WCM in the United States. I mean, at the end of the day, what I've found is that a lot of these guys, what they have in common is that they're looking for some form of change. There's a great investor on Twitter named Elliot Turner who is also very good at that, and he's a super nice guy too. And we discuss this all the time. And I think that so in terms of change, the way that I like to think about it is that basically the valuation of a business probably won't change unless something is changing intrinsically about the company. And so I sort of like to look for situations where there's some form of change. So I don't really run screens, sort of quant screens or anything, like that, but I do, if I am going to screen for something, it's going to be change. And by that, I mean sort of, it might be a new management team. It might be a strategy update or adjustment. It might be a business model shift or pivot. It might be a meaningful increase in research and development or CapEx. It might be a large increase in OpEx. It might be sort of a new product or a new market they're launching, or a new region. Those are the types of things I'm looking for, because investors typically, extrapolate, what's happened in the past. And if something is going to lead, the future to not resemble the past, it has a reasonable chance of not being properly picked up by investors. And so I think that's an important sort of aspect of how I look at things. And I'm relating that to valuation. I think the typical thing you're going to see on valuation is someone is going to say, okay, given stock is trading at 25 times earnings, which is, well above or below the 5-year average, and well above or below its peers, and therefore the stock is far too expensive or inexpensive. And I don't use that framework at all. Like I don't think it's particularly useful to do things that way. And I think that the way that I think about it is that, first, like, intrinsic value for me is based on risk and time adjusted long-term cash flows, and earnings might correlate with free cash flow, but they're not the same. Earnings don't include the capital required to generate growth. And a single year's worth of earnings has very little to do actually with long-term cash flows and value creation. So I think it's a poor proxy for intrinsic value. And I realize that, some people are going to say, yeah, well, if you look at the DCF and the terminal value calculation, if you take, the the weighted average cost of capital minus the sort of long-term growth rate or residual growth rate, and you invert it, that's a multiple. But yeah, it is, but it's a multiple on cash flows a long time from now. And those things are explicit, so you can think about them. So I don't want to make it seem like I'm a diehard DCF fan, but I'm just saying that I think there's another way to approach it, and I think that using shortcuts is just not a good way. And that includes, you know, all the traditional price to earnings, EV/EBIT, EV/EBITDA, price to sales. I really don't use any of those in my framework. And I think so. If you wanted me to discuss how I think about valuation, I think at the end of the day, it's about expectations. And I think that, you know, we're looking for companies that we think can surpass expectations. And I try to think about that both in explicit terms and implicit terms. So I guess the former can be sort of done in two ways. You can sort of look at Bloomberg consensus over the next few years for the sell side and assume that, you know, the buy side is often quite similar to the sell side. You can look at company compiled consensus, which often goes out a few years. And so that can give you a good idea of, you know, what kind of organic growth and margin improvement and working capital dynamics and CapEx and free cash flow is the market estimating, and trying to figure out, you know, is that realistic or not? The other thing is to run a reverse DCF. And what I do with that is I just look at, you know, 5 or 10 sell side notes, try to figure out what sort of weighted average cost of capital they're using and what sort of, you know, residual growth rate they're using. And then I plug in the free cash flow, you know, growth rate or duration to get to the current valuation. And then I try to say, hey, do those things seem realistic to me? And what sort of things would break the model? So what sort of things would cause, you know, either, you know, the free cash flow side or the risk side, so the discount rate, or to be significantly different than what people think. And, you know, that's been very useful to me. And what it allows me to do is not fall into the trap, which I did in the past, of, you know, owning a business and selling it because the multiple looks expensive. You know, a business with a low multiple that surpasses expectations will probably outperform. A business with a high multiple where the company surpasses expectations can also outperform. So I think really, if you focus on it that way, it's a different angle, and that, and, you know, it's, you know, I get a lot of flack for this. We discuss it and people sort of say, how can you not look at multiples? But I found that I've become a lot more successful. It's been maybe 5, 6, 7 years since I stopped really, you know, using them as much. And I've been a lot more successful doing it. And I just want to put a caveat. I realize that some people might say, man, how late cycle is this? He's talking about not using multiples. It's not a question of not paying attention to valuation. I think valuation is super important. I just think that I don't think the traditional way of looking at it is particularly useful to me. And so, yeah, I hope that sort of answers the question, and to sort of, and so in the end, when I'm thinking about that, I'm sort of thinking, how can these changes lead to either, you know, higher free cash flows than the market thinks, or lower riskiness of those free cash flows than the market thinks? And I think that's another thing that's super important, is that I think what we're taught at school, right, is you want to buy businesses at a discount to intrinsic value, which makes sense. I mean, who wouldn't want to do that? I think it makes a lot of sense. But let me ask you a question. If you have a stock that returns sort of 10 or 20 times over the number of years, what does that mean? Does that mean that people purchased at sort of a 90 or 95% discount to intrinsic value at the onset? Or does it mean that it's now trading at, you know, a significant premium to intrinsic value? So what drives the return? You know, some people might say it's time, which is true. The roll forward of the DCF does that. I think it's also that intrinsic value isn't static, and it changes, and that it changes based on you know, how you know, future value creation plays out relative to expectations. And I think if you either invest more capital at attractive returns than the market thought, or you improve returns on capital versus what the market thought, or you extend the duration of your competitive advantage versus what the market thought, or the riskiness, either in terms of aggregate rates or your capital mix, or you know, the beta or risk premium, if those things are different than what was initially thought, then, you know, you create more value than was initially assumed, and the intrinsic value goes up. And I think that's what drives the significant returns over time, is changes in intrinsic value. And so, you know, that's sort of how I think about things a lot. And when I'm going through companies, I'm often asking myself, you know, is this the type of business where intrinsic value can increase? And I think that's an important component. And I think that if you focus too much on having this intrinsic value initially in the static approach, you miss a lot of companies. And I myself, this came from, I owned Amazon from 2009 to 2014, late 2014, and it did pretty well. And then it went up 10 times after I sold. And I think I realized this maybe a year or two after I sold, and it already doubled or tripled. I was like, there's something wrong with my framework. So this is sort of like maybe 6 years ago now. Almost 7 years ago. And I sort of was like, there's something wrong with my framework. If I'm missing things like this, then there must be something that I'm doing that's not right. And I think that if we were in any other field and there was a framework that people used that consistently showed something was unattractive, despite it actually being attractive, they would question it. And whereas people in our business don't tend to do that. They sort of accept this framework that I think is commonly used, which, I think is a mistake.
Well, no, I mean, and this is putting everything that you brilliantly just said as simply as possible. I mean, at the end of the day, stock price is not something that as investors, if you're truly an investor, stock price is something that you shouldn't take so much, put so much weight in that. What you really should be doing is a lot of what you're saying, whether it's what you're saying or some of the other investors I've had on here, is just focusing on trying to come up with your own thesis for what you think the company will be valued at. Because if it's already overvalued based on what you see today, then okay, it's overvalued. Maybe you don't want to be part of. Okay, that's fine. But if you're not looking at stock price and you come to that conclusion, okay, I think we can all make an argument of like, all right, if that's your perspective and that's how you think about it, that's fine. But if you're not thinking about stock price and you're seeing that this company can be worth, whatever multiple or this, 5, 10, 15 years down the road, then it really shouldn't matter what, if it's trading at a 10, 20, 50 times multiple today, and that the price is probably going to take a huge steep drop at whatever price you bought it at, but you are confident in the core underlying business that you're willing to take that ride.
I fully agree with that. And another thing related to that is like, I think that it's important to have principles and a framework that sort of can work irrespective of era or of region or of maturity or size of the company. And I think that like using shortcuts like multiples, they don't work for all situations. And if they don't work, then for me, that means the framework is flawed in a sense. Like how do you value, how do you value an early stage company or, a small cap company or a micro cap that doesn't have any earnings or in some cases, has even moderate sales? I mean, if you can't use those shortcuts for those. And therefore, I think that there's a better framework to be used. And I just try and think to myself, what is free cash flow per share going to look like over the medium long term? And try and think about the riskiness of it. And I found that framework has just worked a lot better for me. Very
cool. All right. So we're going to, my final question based on the presentation that you sent to me prior to the interview to get prepared is there's 2 sections that I wanted to kind of get your quick take on is how you think about risk management and portfolio construction. So, what's your take on that? And then we'll get to some of your other Twitter threads that I think people would love to hear more about.
Sure. I think so on risk management, there's a host of ways to do this. And I don't claim by any means to be an expert. I can just speak about how I sort of approach it. And I think that sort of you can think about it on a company specific standpoint and on a portfolio standpoint. And there are sort of 2 ways that I deal with that. I agree with something that Anthony Bolton said, which is basically that, to generate a great long-term track record, you need, just 2 things, a few big winners and an avoidance of disasters. And I think that, a big part of how I think about risk management is how can I avoid disasters, both at a company standpoint and on a portfolio standpoint. So on the company standpoint, outside of, listing out the risks that I think that, you typically can find when you think through this type of stuff, sort of, I'm sure you've seen people talk about these 1,000 times, sort of poor understanding, low quality, overvaluation, cyclicality, obsolescence, regulation. There's a host of things that, everyone looks at. I look at those too. But I think that more importantly, I try to have something in my process that sort of, in French, there's an expression called a garde-fou. And what it means is like something that stops you from doing something crazy. And for me, what that means is that I sort of have an ethos of, cut losses, ride winners. And what I mean by that is, when I'm building a new position, I have no problem, averaging down initially. But once I reach my full position target, if it's down sort of 25% from there, in a normal market conditions, so that's to say not in a bear market, then I usually just sell the position. Because if I already thought that it was mispriced beforehand, I've already started averaging down and it still goes against me, then I in my experience, more often than not, I just miss something. And so, I prefer to pass. And also it beyond that level is where the asymmetry of gains and losses really kicks in. Like if you're down 30%, you need 43% to make it back. If you're down 40, you need 67. If you're down 50, you need 100. So beyond that sort of 30% loss threshold, it becomes tougher to make back. And it can become disastrous. I mean, if you let it, go a lot further than that, and if there's multiple instances of it. So I try to just limit that altogether. And then the second thing, related to sort of a portfolio management aspect is diversification. And to me, that is less about the number of positions in the portfolio, and it's more about their correlation. So I sort of have different ways of thinking about the positions in my portfolio. I have, situations that I would characterize as sort of durable growth and quality, situations I would characterize as sort of, rapid or very rapid growth and quality, and situations that I would characterize as sort of cyclical growth and quality, and those I would characterize as sort of recovering growth and quality. And what I like to do in the portfolio is have a balance of those different things. And what that means is that, if you get into an environment that's, highly momentum driven, like in the late 90s, if you tend to have too many stocks that are all of that sort of type, when things change, it can be significantly painful. I mean, in terms of the drawdowns you can have. And by contrast, if you're in, late 2006, 7, and, a lot of the cyclical inflationary type stuff is done incredibly well, and you find yourself with a lot of those ideas, that also can lead to a significantly bad outcome. So from my experience, having a balance of those things, because each of those buckets will react differently depending on the environment. So if we're in an environment where, inflation is rising and is quite high, then, the cyclical portion will do quite well. If we're in an environment where, we're recovering out of a very tough economic situation, the recovery aspect will do well. If we're in an environment that's very deflationary, then the durable aspect will do well. If we're in an environment where sort of it's very momentum oriented, the rapid stuff will do well. And so, what it really allows me to do, I think, is focus on the stock picking, and that's what's going to drive the difference, and not, sort of some view that I have on which sectors are going to do better. And because I think that's really hard to do. And I just want to have some balance there, and that's how sort of I approach it, and to never have a disaster from that standpoint, hopefully. And that also is particularly important today, I think, with interest rates where they are. Like, I'm not a macro investor, even though there's a lot of really smart guys that do that, and I respect their approach. But I do think that when you invest in quality businesses, you structurally, it's hard to argue that you haven't benefited significantly from interest rates going, from 15% in the early 80s in the US down to, effectively 0 on the 10-year today. I mean, just, quality businesses and growth businesses are longer duration assets where a lot more of the values in the future, and therefore they're a lot more sensitive to rates. So I think a lot of people, if you look over the past 10 years, potentially don't realize the extent to which their portfolio has done well because of that component, because of the lower discount rate. And you can see it. Look back 5-6 years ago at sell side reports, and you have like 9-10%, discount rates. And now, on some high quality companies, we're at 5%. And so, some people may tend to think that just having decent earnings growth is enough to outperform over time. I think that's going to be less true over the next 10 years than it was over the last 10 years, if I had to guess. And I think that's an important sort of aspect of things, and having a balanced portfolio relating to that, I think, is also important in to, avoid a situation where everything in your portfolio reacts similarly. And so like when I look at my portfolio and I see some things having a great day and other things not having a great day, I usually think of that as a good sign of balance. And if I had everything reacting similarly, I would be a little bit scared, I think.
Fair enough. I mean, these are all great points right here. So, okay, I wanted to continue on because you've put out quite a few interesting investing threads on Twitter, and some of which that you sent me previously, and I had a chance to go through prior to our chat, and a couple that stood out to me that I wanted to really talk about here and get some more insight, because I think we're at that point in the interview where it's a good chance to reflect on, especially your history and getting to where you are today. One in particular, you talked about how the concepts of quality and contrarianism really helped you grow as a traditional value investor that you were when you say you got started like around 15 years ago. So you want to provide a little color on that thread and how you as an investor have changed in your career to where you've gotten today?
Sure. Yeah, good question. I think that I talked about a lot of things in the thread. I think one of the most important things is focusing on the delta, or sort of the second derivative of things. Like sort of, it's nice to have a competitive advantage, but if we look back 10 years ago, there's a lot of businesses that we would have said this company has a great competitive advantage, and today they either no longer exist or are struggling in a significant way. And so I think looking at the direction in either the strengthening or the weakening of competitive advantage is super important. And it's something I didn't do initially. And I found myself with sort of owning shares in eBay for a number of years, which was a mistake, in the past at least. And if I had been paying attention more to, are they getting stronger or weaker in terms of the competitive dynamics, I would have probably avoided that mistake. And I think the opposite is also true in terms of finding opportunities. So, and that's true for competitive advantage. It's true for value proposition. It's true for industry structure. It's true for management capital allocation. I mean, focusing on the second derivative, I think, is super, super important, and something that I didn't do initially, when I started, let's say almost 20 years ago now. I think probably the other important thing there is, for me at least, is maybe on the quality side is spending a lot more time not behind my desk, essentially. Early on, I spent a lot of time just purely reading, and maybe because I was a bit more shy, or maybe because I didn't want to spend the time doing it. I didn't get out on the road enough. I didn't speak to enough people. And I made that a conscious sort of part of my process. And I think you learn a lot of things from people on the road and across the value chain that you don't learn in documents. And so that's another thing that has helped me improve a ton over the past sort of few years in terms of, the quality aspect of things. And then on the contrarianism aspect, I think really, like, I tend to think that, people that are contrarian are always contrarian. So it's a character trait. And as I said earlier, I think markets are somewhat efficient, pretty efficient. And so if you're contrarian all the time, I mean, I think it's a tough game. And so I think that, trying to be creative and imaginative and independent in your thinking is a much better goal than trying to be contrarian, and trying to always find situations where I think there's two ways of approaching the market. I think there's, initially maybe when I started, I was sort of like, the market's very inefficient and there are so many opportunities. And then, as I got hit in the face a bunch of times, I sort of gradually moved towards the market's pretty efficient, and big mispricings don't occur that often. And so, I think that's another sort of important thing that, I would think is changed me sort of quite a bit, over the past few years. I think those are sort of a few of the things that I would pull out of that thread that I think have been particularly useful to me.
I think there's a lot of microcap investors out there listening and being like, Eric, what do you mean? The markets aren't efficient. That's our opportunity. What are you talking about? But hey, this is an opportunity to say why the market still might be somewhat efficient, and yet you can still find opportunities with microcaps.
Yeah. I mean, well, look, if the market were perpetually inefficient all the time, then those microcaps that you were buying that the market was missing, I mean, what's going to cause the market to figure it out? I mean, it's because, it trends towards efficiency, and because it's very competitive and there are a lot of smart people in the market. And sure, there are pockets of tremendous inefficiency, but there are pockets. It's not like in aggregate, everything is so inefficient all the time. And I think
That's
it's
fair.
Also a mindset thing. If you think that way, you respect the market a little bit more. And to me, that's made a big difference in terms of the way that, like I spend a lot more time questioning, is this really that good of an opportunity? Why are people missing this? Like what's, and that relates to the mispricing aspect of things, but yeah.
Right. Yeah, no, maybe we should qualify it as like, look, it's inefficient when the companies have no love, and then they're efficient when they're getting all this love. Yeah, there's so much efficiency is rampant. My portfolio is doing great.
That's hilarious.
As I said at the beginning of this interview, I also grew up playing a lot of jazz music. I'm a drummer personally. I'm killing to play a set right now. I think that's the one huge cultural disadvantage to being a drummer, is that it's impossible to ever, it's very hard to figure out your space and get that all figured out. All too well, because even as a fellow musician, you're like, oh, this freaking guy is so loud over there. Sometimes, usually we're just banging stuff and just trying to figure it out. Other than like guitarists, where at least sounds nice when you're still just trying to figure it out. With us, it's just bang, bang, bang. But anyways, you put out another Twitter thread that I loved, where you said that it was on the 2 things that helped you improve as a guitarist that have applications for investing. So can you describe those?
Sure. I guess the first aspect is in guitars and any soloing, really, there's sort of a trend towards, memorization versus understanding. And what I mean by that is that people will memorize scales instead of trying to understand, why certain notes sound good in a given context. And, for people that don't play music, scales are sort of patterns that can be played over certain chords. And chords are really what make up songs. Chords are just a few notes that are played together. And so, the using scales, like you can buy books with these patterns of which scales work over which chords and etc. And, what ends up happening when you do that is that you get what's called stuck in a box. So, you'll take I'll give you an example. In blues music, there's the scale called the pentatonic scale, which is used a lot in blues. And it's a nice, neat little shape that's very easy to play. And when people learn, they initially memorize this shape and then they play it over the entire blues song. And what ends up happening is they end up, playing like sort of all the notes are appropriate, but they end up playing sort of random appropriate notes at random points. And it doesn't really sound like music. And when it sounds good, they don't really know why it sounds good. It's very mechanical, and you end up sounding like everybody else. And sort of the best players don't think using scales, because they understand how chords are constructed, which notes are going to sound good in a given spot. And most importantly, they understand how to transition between different chords and anticipate those chords. And that really is what makes them sound musical. And, there's a great French, probably one of the best guitarists in the world. His name is Biréli Legraine. He's a French gypsy jazz guitarist. And he didn't go to school for the most part. And he doesn't know any scales. And yet he's this unbelievable player, both musically and technically. And when you watch interviews of how he learned, he was sort of like, look, we started playing when we were 3. And we played loads of different songs and jams. And we were taught on how to think about chords and how to think which notes sound good in given instances, and not sort of, a mechanical way of playing things. And the way that I think about that in investing is that, sort of ratios and formulas and accounting sort of factors are all things that you can memorize and apply. And, that's similar to learning scales in guitar and really understanding, the dynamics behind future value creation and understanding the inputs to those and really digging into those things is very different. And I think that that's sort of the equivalent of learning how to disaggregate chords and why certain things sound good in a given instance. And then, understanding mispricing and why the company is going to surpass expectations is similar. These are like fundamental things that are principles that work irrespective. And by the way, a great player that understands those things is not only going to sound great to you when you hear it, even though you don't realize it, but they also can play over anything. Like a blues player, someone that only learns pentatonic scale can probably only play over blues music. If you give them a complex jazz piece with a lot of chord changes or classical music, or they fall apart. Whereas someone that understands how chords are constructed and really what's behind things, they can play any style of music. And sort of like one of my favorite guitar players is a guy named Larry Carlton. And he's an unbelievable blues and jazz player. and you can type on YouTube Larry Carlton, Larry's Blues, and you'll hear it immediately. It's sort of very like, the notes are very accessible to people, and it just sounds amazing. And he also is one of the best studio musicians of all time. Played for Barbra Streisand, played for Joni. Like, I can list dozens and dozens. He's won multiple Grammys, and those are all different styles. But the fact that he's so sound in his understanding of things has led him to be able to play, irrespective of era, because he did it in the 70s, he did it in the 90s, he did it in the 2010s, won Grammys in all those eras. He has played over multiple styles. And I think that it's the same sort of in investing. I think if you have a really good understanding of these things, you can do it in multiple regions, multiple company maturities, multiple eras. And you're not dependent on, when, like price to sales right now, or EV to sales is very, popular. A decade ago, it was, asset-based valuation. A decade before that, there's a host of things that, if you're doing that, I don't think that's the right way to approach things. And I think music helps me think about that in that way. And then the other thing is, there's something in guitar playing, which is super important, is that the listener's ears function more slowly than the player's brain. And that's super important, because you'll play something and you'll think that it's getting through to the audience, but often it's too complicated. And so you need to, find ways of bringing in repetition, simplicity, and et cetera. I think that's useful in investing, both in when you build an investment case, but also when you pitch to other people. Often, and this, I'm responsible for this probably even today, is, I'll explain something and I won't realize that what I'm saying is not getting through to the person across. You know what I mean? And so I think, when I understood that in guitar playing, I became a lot more enjoyable to listeners. And I think that, as I've understood that in investing, I think I've tried to simplify things in how I explain, an approach or explain an investment case. And so I think it helps in that way too.
I could not agree with, I agree with everything that you just said, but especially the last bit that you just said, because especially as a drummer, and I'm one of those that I like to be the center of attention. So even if a guitar player is playing his solos, I'll do those extra hits, that you're like, did he have to? But it's because I was anticipating, but it was because I was always anticipating that next lick that you're going to do, or to make, or to emphasize it a little bit more. But going back to your point about, trying to understand why the chords are played in a certain way, and why, using certain scales across all different genres and all that kind of stuff, for a drummer, it's just understanding what typical time signatures are, and understanding why. You would use those different time signatures for, a bossa nova versus a, just typical jazz standard, whatever, or just a rock song, understanding what works and what doesn't work. And then, that's where the improvisation comes in, because then you can just play around, because you're like, all right, as long as I know I got to keep my hi-hat going on 2 and 4, I can do whatever the fuck, pardon my French, I can do whatever the fuck I want, and, I think about it the same way.
That's so right. And by the way, if you just memorized given drum patterns, and then you were playing with people and they were like, hey, we're going to play in a different signature, you would be lost. And so understanding the structure of things like that is super important. I think the same thing applies to investing.
Yeah, 1,000%. All right, dude. Well, I have to ask. This is my favorite question to ask everybody. Actually, that last question that I just asked, that's probably not my new favorite question to ask everybody. So anybody listening that wants to be interviewed by me, you better pick up an instrument. But but Eric, what would you say is an investor experience that impacted you the most in your career? You already went through a couple just now, but what would you say of all of them that has kind of set you on your path?
Sure. I think there's sort of 3 things that I think are important and that I can think about. The first one is sort of something that happened not long after I joined my former firm, maybe sort of 18 months after I joined, maybe 2 years, in that range. And my former boss called me into his office and said, he had a sheet of paper, and on that sheet there was sort of a list of ideas, and he said, look, here's the ideas you pitched since you got here. And, you're reasonably good at the quality stuff, but, the value oriented stuff isn't so good. And so you should stick to what you're good at. And I think most people, when criticized, sort of tend to focus on it as sort of a personal attack, and they get defensive. And so my first reaction was to deflect and protect my ego. And I got out of the office, and the first thing I did was I looked for explanations, and I didn't really have too much trouble finding a few. And it was sort of I looked at how value would perform during that period and noticed that, value was down 10% during the period, and my recommendations were flat. So, relative to the style, it's not that bad. Then I found other explanations. He only selected a subset. He didn't include everything. I just looked for a bunch of reasons. And at the end of the day, after, a few hours, I sort of started to realize that, all that might be true, but it doesn't mean that I didn't make mistakes, and that there aren't things that I can learn about. And the rationalization might have made me feel better short term, but it was pretty much an excuse. The aforementioned factors weren't mutually exclusive to me, having not done a good job. And so, sort of the first thing that I did when I, went over and analyzed those things was that the first thing that sort of jumped off the page is that I was there for, less than 2 years, and there were sort of 20 to 30 recommendations on the page. And I was sort of like, how could I really have known that much about so many companies, or had a differentiated view on so many companies? What it sort of, made me, it sort of ingrained it within me that, I couldn't. And the result was that the track record was mixed. I sort of realized that there aren't that many good ideas, and that you need to be very selective. And that sort of hammered that home. And then, when I looked at all the recommendations, I noted that, there were similar traits to the ones that didn't work well. Like they were, sort of structurally, low return businesses, or average businesses. They were in industries that had structural headwinds and limited growth, and therefore were, highly competitive. They had management teams that had no skin in the game. I mean, they were just things that a lot of them had in common. And so it sort of taught me what to avoid, so that was probably a big experience, because it also helped me figure out that, mistakes are a source of learning. And I had read about it, but it was the first experience for me where I was sort of like, wow, like I can use these mistakes as a way to really improve significantly. And that's just a mindset shift. And since then, I don't want to say that like mistakes are a source of joy, because it's painful when you make a mistake, but it's something that I look at differently than I did before. And it's more constructive now. And so that was a big thing. The second experience, I think I mentioned this before, but it's an important one, is the things I sold that went on to go on a ton. So I owned Amazon in 2009 to 2014. I owned Adobe from 2009 to 2014. Both of those, were significant misses in terms of selling way too early, and that led me to rethink the valuation framework, that I work with. And then the third one is from sort of my sell side days. Sort of late into my sell side days. And it was, I was covering consumer staples, and I sort of met with loads of met or talked to maybe, a few hundred investors a year while I was doing that. So, let's say I spoke to, maybe, 300-400 investors over the period, different investors. And in late 2011, we went with my former boss there to meet an investor in the UK. And I won't mention his name because he's super under the radar, and but he manages a very concentrated portfolio, very low turnover, like very selective, like sort of one idea every 2-3 years. His track record is unbelievable, and I came, we went to the meeting, and he was so different from any other investor that I'd ever met. It was just like he was playing a different game. He knew the companies much better than anybody I'd met, and even than me. So I was sort of like, wow, I cover these companies full time. I spent all my time thinking about 3 or 4 companies, and he knew them better, not only from a numbers standpoint, but from a management standpoint, from a strategic standpoint. Just, it was his way of thinking was just crystal clear and very forward looking and atypical. And, he just struck me as very different. And so I wrote him an email afterwards saying that I really appreciated the meeting, and asking him if we could, have a call to discuss his approach. And he said yes. And so we spoke on the phone. And the recommendations he made shifted my approach quite a bit. His background was very atypical in the sense that he was a journalist. That's how he started his career. And his role was working for a publication in the US was to basically go out and look at an industry, find a company that's abnormally profitable and explain why. And that was sort of the story that he had to cover in each time. And I mean, what an interesting way to learn about business. And so, he suggested that I read every history book on businesses that I could find. He suggested that I contrast business models. So he would say, sort of compare Intercontinental Hotels to other hotel operators, compare Coca-Cola to AB InBev. And he gave me a host of other examples. And what I ended up learning is, while these businesses might seem similar on the surface, he mentioned Costco versus Walmart, and essentially they're all businesses that on the surface seem similar, but there's underlying differences in their business model that lead to very different cash flow dynamics. And so that was a big sort of shift in how I sort of looked at things. And then the other thing is how we bought things. And it seemed like he would buy things at a moment, the timing was also always atypically good. And he didn't explain this to me in his own words. He sort of just said, just look at it and try to, figure it out. And what I ended up figuring out is that he, again, focused on change, and he would buy, into things, that were launching a new significant product or having a significant regional expansion or transitioning their business model. I mean, he didn't own this, but a typical example that I owned and I actually, sold it maybe 6 months ago, but I owned it for, 6-7 years is Microsoft, and the transition in their business model is a good example. And he owned a host of examples like that. And yeah, that was really I think a formative experience and changed how I approach things in multiple ways, and made me, I think, a much better business analyst in the way that I think about things.
And Eric, as we close out here, what advice would you have for new investors?
Sure. I think that an important thing is sort of, what's historically been valued in finance is sort of, skepticism and contrarianism and numeracy and quantitative orientation. And I think that's sort of why so many people, take the CFA and get MBAs. And I think there's nothing wrong with either of those. I mean, I have an MBA. It's not a problem, but I think that markets are becoming increasingly competitive, and there's more and more of CFAs and MBAs, and people think in similar ways and have read the same books and learned the same techniques, and many more using screens. There's many more quant funds. And, I think at this point, those are sort of table stakes, and it's quite similar to poker. I mean, I don't know if you play poker, but I've played poker for over 20 years. And, I remember initially, in 2000, 2001, 2002, before the real boom, people, hadn't studied the game. There weren't that many books. There weren't any forums. There weren't online videos. There weren't training courses. There weren't poker trackers. The games were easier to beat. And then over time, they became much harder to beat because people all did the same things. And I think investing is similar. And so I would say that focus on being more creative and imaginative in your thinking than on being quant oriented. I don't think that that's a differentiator anymore. And I think the people that will be the most valuable in 10, 15 years are people that are creative thinkers and that approach things differently. So I think that's something to strive for. The other thing I would say is to stay away from ideology. And I understand that, value investing, it's, and most people, when they speak about value investing, they're speaking about value as a factor. So sort of low price to book, low PE, whatever the case is. I would say just stay away from that. And the same thing with growth investing. I mean, I think that at the end of the day, what you should be looking for is to buy, a company, a quality business that's mispriced. And I think that'll work irrespective of cycle and environment. And I hope I've explained the nuances of what I mean by quality and what I mean by mispriced. But I'd say try to be pragmatic and non-ideal. And I know it feels better to go into a group and say, I'm a diehard value investor, or I'm a diehard growth investor, but I think that it creates bias. And so I would try to stay away from that. And then, I think that another thing that's super important is to basically understand that you have to develop your own approach. And that means, like, it's great to follow different investors and to experiment with things, but try and understand that you need to take pieces from different, investors and aspects and blend them into your own, or else, you can't borrow conviction. So if you're following someone else's approach and you're really just mimicking it, I think it's very tough to perform well over the medium long term. And then maybe the last thing is to learn how to judge expectations of other people. And by that, I mean that when you're starting out, at least when I was starting out, I would get a view and I would focus so much on my view and what my view was about that I wouldn't realize at the end of the process that maybe my view was the same as everybody else's view or very similar, and that therefore it had limited value. So, understanding, like, once you have a view, to say, okay, what does everybody think? And that can come from speaking to loads of buy side investors, reading loads of sell side reports, whatever however you want to approach that, but try to get a sense of, what other people are thinking, because our job really is to take advantage of gaps between fundamentals and expectations. And you can't do that if you don't know how to think about expectations and about how other people are viewing a stock. So that's another thing I would say. And then the final thing is just to read a lot and be curious and like, read all the books you can, read, the Graham and Dodd investment newsletters, read, blogs and forums on one side, and that'll help you with the theory. And then, this sounds obvious, but, read loads of 10Ks and annual reports and investor presentations. And that's how you start to pick up patterns. And it's the same in music, really. I mean, like, you can't become a good player if you don't listen to loads of music, and your ear starts to get accustomed to things. I think the same is true in investing and in business.
Dude, well, listen, I got the title of this episode already. Lock, stock, and it's Lock, Stock, and Barrel. That's Meredith's Twitter handle. But focus on being more creative and imaginative with your investing process. I think that's a great place to end it right there. And I got my title, so we're good. Look, Eric, with that, where can my audience go find more information, to find all of your insights, to follow you, and to hear everything that you have to say, or read everything you have to say?
Really, it's just on Twitter. I mean, I don't post that often. It's sort of like my investing, but I post a couple of times a month, and I'm happy to exchange with people and get pushback and debate on ideas. So that's probably the best place.
Very cool. Well, with that, Eric, thank you so much for joining me today. This has been an awesome episode, great conversation, and I'm really excited to have our next one.
Thanks. I really appreciate it.
All right, man. Have a good weekend. See you.
You too.
This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.